Think about the last time you looked at a mortgage payment, yours, your parents', a friend's. The number probably included a term, 30 years. It felt as natural and permanent as the address printed at the top of the page. For the first 158 years of the United States as an independent nation, the 30-year mortgage simply did not exist. Not for your grandfather, not for anyone, none. And yet somehow, houses got bought and sold, neighborhoods filled up, families moved onto their own land, hung their own front doors, and left those homes to their children. Every one of those houses had been financed, just not the way you think. So how did any of it actually work? How did a bricklayer in 1890 buy a house on a bricklayer's wages? How did a young couple in the 1920s move into their first bungalow when no bank would lend for more than 5 or 6 years? And why, in the middle of the worst economic collapse in American history, did the entire home financing system snap at once, leaving roughly 1,000 families a day tossed out of their front doors? The question isn't just academic, it's actually kind of urgent. Because what happened in 1934 didn't just create a new kind of loan, it rewired what it meant to be middle class in America. The house you live in, the neighborhood you grew up in, the wealth your family does or doesn't have, most of it traces back to a single law signed in a Washington summer and to the strange, half-forgotten world it replaced. The answer is a story of comb makers pooling money at a tavern, 5-year balloon loans, penny auctions in Iowa cornfields, a country judge dragged off his own bench with a rope around his neck, and a president who signed a bill on June 27th that changed how nearly every American would live for the next 90 years. So let me take you back to the beginning. Imagine you're a shopkeeper in the 1820s living in Frankfort, a small village just north of Philadelphia. You work with your hands, you save what you can, and one afternoon you decide, like a lot of Americans decide, that you'd like to own the roof over your head. You go to see a lender, and here is what the American home mortgage looks like on average in 1825. You are expected to put down half the purchase price in cash. Half. If the house costs $800, you need $400 sitting in front of you before the conversation is even worth having. The loan itself runs 3 to 5 years. You don't pay down any of the principal during those years, you just pay interest, month after month. And then, at the end of the term, the entire original loan comes due in a single balloon payment. All of it, on one day. Now hold on to that word. Balloon. It's going to matter later. If you can't come up with the balloon, and almost nobody can, you refinance. Which really means you go back to the lender, hat in hand, and hope they roll it over for another 5 years. If credit is tight, if the local bank is nervous, if the country is in a panic, they don't. And you lose the house. That was the American mortgage in 1825. It served the rich, the merchant class, and the well-connected. For a working family, it was, in practice, impossible. Which brings us to a back room at the Sun Tavern in Frankfort, Pennsylvania. On the evening of January 3rd, 1831, 37 men, mechanics, weavers, small tradesmen, sat down around a table and quietly did something revolutionary. They founded the Oxford Provident Building Association. It was the first building and loan society in America. The idea was simple and honestly kind of beautiful. Every member would pay a small weekly due out of a modest wage. As the pool of money grew, the members would take turns. Whoever needed to build or buy a house first would get to draw a loan from the shared fund. They'd pay interest back into the pool, plus keep contributing their weekly dues, and eventually the whole society would have paid for a whole street's worth of houses. The first person to draw was a young comb maker named Comley Rich, Comley. In April of 1831, he took out a loan of roughly $500, verify exact figure, and bought a modest brick row house on Orchard Street. That house, the first house in the United States purchased with money from a building and loan, is still standing today. Remember it. We'll come back to it. The Building Society model, or B&L for short, is the ancestor of every credit union and thrift in America, and it worked on a completely different logic from the commercial bank. A commercial bank was a business owned by outside shareholders using deposits to make loans at a profit. A B&L was owned by its own members. The people borrowing the money were also the people funding it. You didn't just get a loan, you bought shares in the association, and as those shares grew in value, they eventually equaled the debt, at which point the loan was retired. It was a slow, patient, cooperative kind of finance, and it built entire neighborhoods. Here's the thing most people don't realize. This wasn't a fringe movement. By 1900, there were more than 5,000 building and loan associations in the United States, verify, holding the mortgages of ordinary working families in every industrial city in the country. By the 1920s, B&Ls held nearly a third of the country's residential mortgage debt. But B&Ls weren't the whole picture. If you were middle class, a manager, a professional, a comfortable clerk, you probably borrowed from a commercial bank or a mutual savings bank instead. Those loans still followed the old pattern, 50% down, 5 to 11-year term, interest only, big balloon at the end. And if you were wealthy, you likely borrowed from a life insurance company, which had a lot of long-term money to invest and liked mortgages backed by prime real estate. So the American housing finance system, on the eve of the Depression, was a three-tier stack. Building and loans for the working class, commercial and savings banks for the middle, insurance companies for the top. Each layer had its own culture, its own rules, and no federal regulator tying them together. And on top of all of it, in the 1920s, sat Herbert Hoover. Before he was president, Hoover spent nearly 8 years as Secretary of Commerce, and he was obsessed with homeownership. In 1921, his department launched a national Own Your Home campaign, complete with pamphlets, radio addresses, and partnerships with builders and lenders. Owning a home, Hoover said, was the surest way to make a good citizen. Renters were suspect, owners were rooted, and it worked, sort of. Homeownership crept upward through the 1920s from about 46% to nearly 48% by 1930. Florida had a full-blown land boom. Los Angeles doubled in size. Bungalows sprouted across the plains. On the surface, the American dream was in bloom. Underneath, the machinery was creaking, because the whole system still ran on those short balloon loans. Every 5 or 7 years, tens of millions of American mortgages had to be refinanced. It worked as long as banks were open, healthy, and willing to lend. And for 100 years, they mostly were. Then October of 1929 came, and the quiet machinery began to seize. Now imagine you're a machinist in Detroit in the summer of 1930. You bought a small frame house 4 years earlier, in 1926, when things were good. You put down $800, everything you'd saved. The mortgage was for $1,800 at 6% interest on a 5-year term. Every month you've paid $9 in interest to the bank right on time. You've never missed a payment. But your 5-year term is up. And that $1,800 balloon payment, the full original loan, comes due next month. You don't have $1,800. You never did. Nobody in your neighborhood does. That was never the plan. The plan was always to walk into the bank, sign a new 5-year note, and keep going. Except the bank isn't lending anymore. The bank is barely open. Half your neighbors have lost their jobs. Depositors are pulling their money out. The bank looks at your loan, looks at the value of your house, which has fallen 40% since you bought it, and it declines to renew. And that is what a balloon does when the credit market freezes. It pops. Multiply that machinist by hundreds of thousands. In the depths of the Great Depression, foreclosures ran at roughly 1,000 American homes per day. Verify. 1,000 front doors every day for years. By 1933, nearly half of all urban home mortgages in the United States were in default. Verify. In some cities, the figure was higher. To put that in modern terms, in the very worst year of the 2008 subprime crisis, the United States recorded about 2.9 million foreclosure filings across nearly 130 million households. In 1933, the base of homeowning households was a fraction of that, and the raw damage was in the same order of magnitude. Proportionally, it was worse, much worse. Here's the critical detail most people don't realize. The Depression didn't destroy the American mortgage system by being unusually cruel. It destroyed it by doing exactly what the system had been quietly designed to do all along. The balloon was a bet that credit would always be available to refinance it. When that bet failed for one family at a time, it looked like bad luck. When it failed for millions of families at once, it looked like a design flaw. Because it was. The country needed help, and in 1932 it started to demand help. Not just quietly, but loudly, and sometimes with pitchforks. President Herbert Hoover, the same man who had cheered on homeownership in the 1920s, tried to respond. In July of 1932, he signed the Federal Home Loan Bank Act, which created 12 regional home loan banks. The idea was to give struggling thrifts and B&Ls a place to borrow when their own deposits ran low, keeping the pipes open so ordinary families could refinance. It was a real step, but it was small, cautious, and years too late. By the time the home loan banks were operational, the housing market was already in free fall. And out in the countryside, ordinary Americans had stopped waiting for Washington. They started showing up at foreclosure auctions in cornfields and farm towns across Iowa, Nebraska, Wisconsin, and Minnesota. Whenever a family farm or house was scheduled to be sold on the courthouse steps, 100 or 200 neighbors would appear. Big men in overalls, standing quietly in a semicircle around the auctioneer. The auctioneer would open the bidding, and then, from somewhere in the crowd, a voice would call out a bid. Not $100, not $1,000, a nickel, 5 cents for the whole farm, 10 cents for the whole house. The auctioneer would look up. He would meet the eyes of the outside bidders, the bankers, the speculators, the men in city suits who had come to buy distressed property cheap. He would notice how large and how quiet the crowd was, and more often than not, he would bring down the hammer at 5 cents. The neighbors would then hand the deed back to the family that had just been foreclosed on. The bank had been paid technically. The family had technically lost their home. Then practically they had it back. These were called penny auctions, and they happened by the hundreds up and down the middle of the country in 1932 and 1933. They weren't a movement. They were an immune response. The system had failed millions of ordinary Americans, and ordinary Americans were making foreclosure physically impossible. And then, on the morning of April 27, 1933, in the small town of Lamars, Iowa, the story crossed a line it could not uncross. A judge named Charles C. Bradley took his seat in Plymouth County District Court that morning to hear a routine foreclosure case. He was around 60 years old, a well-respected local jurist sitting on his own bench in his own town. Word had spread that farm foreclosures were on the docket. A crowd of hundreds of angry farmers, organized loosely under the Farmers Holiday Association, led by an old union man named Milo Reno, poured into his courtroom. They demanded he stop signing foreclosure orders. When he told them the law was the law, they lost patience. They dragged Judge Bradley off his bench. They pulled him out of the courthouse and into a truck. They drove him out into the country, several miles from town. They took his pants and his shoes. They put a rope around his neck, verify exact details of the noose. They pushed him down on his knees in the dirt of a country crossroads and demanded he swear an oath, right there, never to sign another foreclosure order. He was rescued before he was killed, but the message had been delivered. Governor Clyde Herring declared martial law in Plymouth County the next day. National Guardsmen with fixed bayonets rolled into Lamars. Dozens of farmers were arrested. Newspapers across the country ran the story on the front page. Think about what that image meant. A courtroom had, in effect, been overrun by its own countrymen. A judge, a symbol of the legal order, had a noose around his neck because he had tried to sign a foreclosure order in a depression. This wasn't Iowa being weird. This was the American countryside sending Washington a telegram. In blood, if it had to. And it worked. Within weeks, more than half the states in the Union, including Iowa, had passed emergency laws freezing foreclosures. Verify exact count. The old private mortgage system, the one that had run American housing for 100 years, had lost its ability to enforce its own contracts. But the housing crisis was only one front. Because at almost exactly the same moment, the banks themselves, the same banks that made the mortgages, were failing. On the morning of February 14, 1933, Michigan Governor William Comstock declared an 8-day statewide bank holiday. The two biggest bank holding companies in Detroit, the Guardian Detroit Union Group and the Detroit Bankers Company, were on the edge of collapse. If they went down, they would take with them a huge share of the mortgages, deposits, and life savings of southern Michigan. The shutdown was supposed to be a firewall. It became a fuse. Within 3 weeks, the panic had spread to almost every state. Depositors lined up around city blocks trying to withdraw their money before their banks failed. By March 4th, Inauguration Day, for a new president named Franklin Delano Roosevelt, nearly the entire American banking system was either closed or on the verge of closing. 2 days after being sworn in, FDR declared a nationwide bank holiday. Every bank in the country. Shut. For 4 days, he and his advisors worked, largely without sleep, to draft an emergency plan. By the time the dust settled, the American homeownership rate had fallen from 47.8% in 1930 to 43.6% by 1940 FARS, the sharpest peacetime decline in American history. Roughly 5 million families had either lost their homes or narrowly avoided losing them. Verify figure. By that spring of 1933, almost everyone in Washington agreed that something new had to be built from the ground up. The only disagreement was over what. FDR had a plan, and what he built in the next 14 months is the American mortgage you know today. The plan came together fast. It's worth slowing down here because the details are the whole story. On June 13, 1933, barely 3 months after his inauguration, FDR signed the Homeowners Loan Act, creating an emergency agency called the Homeowners Loan Corporation, or HOLC. Between 1933 and 1936, HOLC would refinance roughly 1 million distressed home mortgages, about 1 in every 5 owner-occupied mortgages in the entire country. Verify. Families were pulled out of foreclosure, one loan at a time, and given a new one. But it wasn't just the scale that mattered, it was the shape. The HOLC loan was fully amortized. Let me explain that in plain English. In an amortized loan, your monthly payment covers a piece of the interest and a piece of the principal every single month. Instead of paying nothing but interest for 5 years and then owing a giant balloon, you're slowly, steadily paying the loan down from the first month. By the end of the term, the loan is simply gone. No balloon, no refinancing cliff, no trapdoor, HOLC also stretched the term of the loan out to 15 years, 3 times longer than the typical balloon mortgage that had just collapsed. Longer term, lower monthly payment, and no cliff at the end. It sounds obvious in hindsight. In 1933, it was a revolution. HOLC, though, was emergency triage. FDR and his team knew they needed a permanent replacement for the entire private mortgage market, one that would keep working long after the emergency was over. So they turned to two men, among others. James A. Moffett, a hard-nosed executive from Standard Oil of New Jersey, was tapped as the first head of a new agency called the Federal Housing Administration. Working alongside him and other economists inside the administration was Mariner S. Eccles, a Utah banker and later that year chairman of the Federal Reserve. Eccles had watched the Western economy come apart from the inside of his own family bank. He believed deeply that the federal government had to make ordinary long-term homeownership safe, or America would not have a middle class at all. The plan they helped design was, on paper, elegant. The federal government would not lend a dime of the money. Private banks and thrifts would lend as they always had, but the federal government would insure the loans against default. In exchange, the loans had to meet strict federal standards. They had to be long-term. They had to be fully amortized, like the HOLC loans. They had to allow lower down payments, first 20%, later much less. And they had to be for houses that met minimum construction and neighborhood standards set by federal appraisers. Private banks would love this, the plan's supporters said. Federal insurance would take almost all the risk off their books. They could lend for 20 years to a working-class family, and if that family defaulted, the government would make the bank whole. Private bankers on the whole hated it. The American Bankers Association fought federal mortgage insurance publicly and hard. Their argument was that the federal government had no business standing behind private loans. It would distort the market. It would socialize losses. It would create a permanent expectation that Washington would rescue every housing downturn. Once the pipe was laid, they warned no one would ever be able to turn it off. They were, it turns out, partly right. But their alternative, a return to the old private market, was politically impossible after Lamar's, after the bank runs, after 5 million lost homes. The bill moved through Congress in the spring of 1934. On the afternoon of June 27, 1934, in a Washington summer that had already worn everyone out, Franklin Roosevelt signed the National Housing Act. The Federal Housing Administration was born. For the first time in American history, the federal government stood as an insurer behind the mortgage of an ordinary family. Now here's the piece to get right, because the title of this video slightly overpromises it on purpose. FHA in 1934 did not immediately produce the modern 30-year mortgage you know today. Insured terms were initially capped at 20 years. They were extended to 25 years in 1938, verify, and stretched to 30 years by the late 1940s, verify. The 30-year fixed-rate mortgage, as most of us picture it, the one you can walk into a bank and get today, was the child of the 1934 Act, not its twin. The chassis was built in 1934. The final body wasn't bolted on until after the Second World War. And here is where any honest telling of this story has to slow down and say something hard. The FHA also inscribed racial exclusion into the American mortgage on a national scale. Its 1938 underwriting manual literally instructed appraisers to look for harmonious, meaning racially homogeneous, neighborhoods. Working with maps produced by HOLC surveyors, appraisers color-coded neighborhoods green, blue, yellow, and red. Green got insured. Red, overwhelmingly black neighborhoods did not. That practice, redlining, is a large part of why the post-war homeownership boom that transformed white families' wealth largely bypassed black families. It was legal until the Fair Housing Act of 1968. It is a permanent scar in the American housing system, and the same 1934 law that built the middle-class ladder for many families also, deliberately, cut its rungs for millions of others. The rest of the machinery followed quickly. In 1938, the government created the Federal National Mortgage Association, Fannie Mae, to buy FHA-insured mortgages from banks and create a national secondary market for them. In 1944, the GI Bill added VA-guaranteed loans for returning veterans. In the post-war boom, homeownership climbed from 43.6% in 1940 to 55% in 1950 and 61.9% by 1960. Whole suburbs, Levittown, Lakewood, Park Forest, sprang up on FHA-insured lending. Almost every one of them was, by federal design, white. The bankers had been half right. The permanent federal role never went away. But the alternative they wanted, a return to a private, balloon-based, half-broken market, was not something the country was ever going to accept again. The mortgage in your name today is a direct descendant of what Roosevelt signed that Wednesday afternoon. When you zoom out and look at this whole arc, from the Sun Tavern in 1831 to the National Housing Act in 1934, the story is really about one question, not one that gets asked out loud very often, but the one everything else in this story is answering. Who bears the risk of putting a family in a house? Before 1934, the answer was almost entirely the family itself. The comb maker in Frankfurt, the machinist in Detroit, the bricklayer in Chicago. If credit tightened, if the balloon came due at the wrong moment, if the local bank went under, you lost the house. The bank was mostly protected. The insurance company was mostly protected. You were not. That was the design. After 1934, the answer began to shift. Federal insurance meant that when a loan defaulted, taxpayers made the bank whole. Fannie Mae meant that mortgage risk could be spread across the whole national capital market instead of a single small town. VA loans meant the federal government stood behind veterans' housing directly. Piece by piece, the risk of putting a family in a house moved off the family and onto a shared federal balance sheet. That is why, in one generation, homeownership went from a coin flip to a majority experience. It's why the American middle class, as we understand it, the one with a mortgaged suburban house at the center of its identity, is essentially a post-war invention. It's also why every major housing debate since is, in some way, a debate about the shape of what was built in 1934. The 2008 financial crisis, at its core, was about federal risk-bearing straining under new pressures, mortgage-backed securities, Fannie and Freddie, and the quiet assumption that Washington would ultimately backstop the whole market. When people argue today about FHA loans, first-time homebuyer credits, conforming loan limits, or whether Fannie and Freddie should be privatized, they are really arguing about how much of that risk we want to keep on the federal balance sheet and how much we want to push back onto the family. Remember the balloon, that funny word from the opening. That's what a mortgage looks like when the family carries all of the risk. When the country tried it that way, the balloon eventually popped for 1 million families at once. And remember Calmly Rich's house. That small brick row house on Orchard Street in Frankfurt, Philadelphia, still stands. Almost 200 years after a young comb maker walked in with a loan from 37 neighbors at the Sun Tavern, it is, in a very quiet way, the first house on a road that runs all the way to your own front door. The world before 1934 wasn't a libertarian paradise. It was a world in which the collapse of a local bank could take the roof off a hardworking family's head in a single week, in which a country judge in Iowa could be dragged into a crossroads with a rope around his neck because the enforcement of ordinary mortgage law had become intolerable to ordinary people, in which nearly half of urban homeowners were in default on their mortgages at once. The world after 1934 wasn't a promised land either. It was a world of federally underwritten prosperity for many families and federally engineered exclusion for millions of others. It was a world in which taxpayers took on a permanent role as silent guarantor of a private industry, with all the moral questions that raises whenever the industry misbehaves. Whether that older world was better or worse than the one we live in now depends entirely on what you value. But understanding that it existed, understanding how it worked, and understanding what replaced it, that's essential for anyone who wants to make sense of the housing arguments that dominate American politics right now. Because the question at the bottom of it all, the one that's been alive since 37 men sat around a table at the Sun Tavern in 1831, has always been the same one. Who ultimately carries the risk of housing? The family? The banker? The taxpayer? The state? That question hasn't been settled. It's being fought over in every housing bill, every rate decision, every first-time buyer program on offer in your town right now. If this story shifted the way you look at the house down the street or the payment coming out of your own account on the first of the month, subscribe. We go deep on these kinds of hidden systems, the ones that shape your world in ways most people never think about until someone shows you how they were built. And if you want to keep pulling on this thread, there's another video coming soon that you will not want to miss.